Good afternoon, everyone, and welcome to our webinar, Regulating AI in Banking. I'm Kevin Flanagan, Director of Marketing for Micronotes, and I'll be your moderator. Before we begin, one quick reminder. You can type your questions into the question box on your GoToWebinar toolbar, and we'll have plenty of time to answer them at the end of the presentation. With that out of the way, let's get started. We have two presenters today. First is Devon Kinkead, CEO and founder of Micronotes. Also with us as a special guest is Mark Casady. Mark is General Partner of Vestigo Ventures. He also formerly was Chairman of the Board and CEO for LPL Financial. And he's also a former member of the Financial Regulatory Authority Board of Governors. And it is that expertise that we're going to call on for today's presentation. So let me turn it over to our first presenter, Devon Kinkead.
Thank you very much, Kevin. And my name is Devon Kinkead. I'm the founder and CEO of Micronotes. And Mark, thanks for joining us today. Would you please introduce yourself?
Yeah, happy to be here. As you heard from Kevin, I am a venture capitalist now. Used to be in charge of a public company, so I have plenty of regulatory experience, let me tell you. From my days of overseeing a company that was regulated by the SEC and regulated by FINRA and regulated by all 50 states, as well as work in the banking channels. LPL serviced over 750 banks and credit unions for retail financial advice. So I've spent a lot of my adult years in the regulatory area and trying to understand how best to help the regulators see new things and how to help think about constructs for those. Some of my fun time at FINRA was helping to work through the regulatory application, the American Job Act, which created a lot of crowdsourcing opportunities, looking at a lot at rules that were affected by new tools like social media quite a few years ago, and thinking about how the digitization of information would change what we gave consumers. So it's always been an area of great interest to me, and watching these intersections of new technology like you've built at Micronotes, come alongside the world of the regulator.
Wow, what a terrific background for today's conversation. Well, we're excited to have you, and thank you again for joining us today. So for the audience at large, we want to thank you as well for joining us. We are here really to set the stage for a conversation about how do you regulate some of these new technologies, artificial intelligence, machine learning. And so to set the stage, though, we probably ought to just take a step back. Right now, AI and ML are in the press a lot. I was actually at a customer's yesterday who the first thing out of his mouth was, "Wow, this is a really hot topic, but is it adding any value to anyone's life today?" And well, that's a really good question. And so first of all, just some subtleties of the definition to set us off on the right foot. So artificial intelligence is I'm not going to read you this slide, but these are things that you are interfacing with today, whether you're talking to Siri or Alexa, and you get some sense of how these simulated human intelligence systems are actually how intelligent they really are. And you invariably find that they're pretty good at doing pretty narrow things, but as soon as you move out of that narrow area of training, they don't give you the best answers always. And then there's a sort of a subset called machine learning, which is really about processing data using specific data structures and algorithms to do prediction based upon patterns that emerge in that data. And this is important stuff. If you're doing things, if you're trying to predict outcomes, it's really the only way to do it. A human can't look at a couple million rows of data by a few 100,000 columns wide and say, "Oh, I see the pattern there." So you have to use machines to do these things. So as we begin to introduce these technologies more deeply into the financial industry space, the financial services industry space, we begin to bump up against the realities of, as we add value, the realities of doing business with our customers and our customers' ability to do business with us. And that's where we run into regulation. And the reason why we're talking about this is because this is where sort of Murphy's Law meets Moore's Law. And one of my former professors at Sloan, Andrew Lowe, and one of his colleagues made this comment, which I thought was cute: whatever can go wrong will go wrong faster when computers are involved. And we'll give you an example of that later in the presentation. But the idea here is that the reason why we want to be thinking about this is because these systems are incredibly powerful and they operate at very large scale. And as the technology gets smarter, it also becomes more autonomous. And as it becomes more autonomous, we run the risk of inadvertently moving outside the regulatory perimeter. And if we do that, then we can potentially present a problem for our customers. So, Mark, tell us about what is just level set us. What are the goals of regulation? Tell us about the supervisory process. Tell us and tell us about your experience when that process sort of comes in contact with new technology.
Yeah, happy to do that. So I think we all agree that regulation in its best form is trying to, first of all, level the playing field between competitors. So not to give the large all the advantages nor the small, to make sure that you've got different business models that are allowed to offer their services to the consumer or to other businesses and allow you to have a competitive outcome in the market. So I think sometimes people forget that part of regulation and good regulation is in fact about capitalizing on our form of economy in the U.S., which is of course pure capitalism. And so as we look at it, how do we make sure the regulation and the regulatory construct is allowing for the freedom of markets to present solutions to buyers? And I think that is really the first goal of regulation. Second goal is in the process of that freedom of markets to bring a solution that no harm is done to a consumer. Again, that could be an individual, they could be a business, it could be any number of things, but how do you make sure that behaviors stay within a bound that's acceptable and allows you to freely offer a service, but do so in a way that doesn't harm. So bring no harm to the investor or the consumer in the examples we're using here today. And then finally, to make sure there's a fair and orderly market is a key part of what happens, particularly at the SEC and at FINRA, where I have most of my experience. But the same can be true among the banking regulators. So how do we make sure, for example, money market constructs are working, that people can trade fixed income, that equities can be traded, that mutual funds get their prices set every day, right? And that is occurring. So orderly markets are another key part of regulation. So if those are the sort of stalwarts under which they're trying to operate, make sure people are competitive, and one model isn't getting regulated more heavily than another. Two is to protect the consumer. Three is to protect the free flowing of markets. What happens with new technology is you have to understand what might it affect when it goes into an impact. And I'll give you one story that I think is illustrative of this example. I was actually talking to my son, who's a student at BU, about AI. And we were talking about driving cars. And he said, if I bought a self-driving car, I would expect that if there's a situation in which I could be harmed as the driver, sitting in the driver's seat, or a pedestrian could be harmed, and that was the only choice, I would expect, because I wrote the check for that car, that it would protect me first, right? That's a profound statement. But as a regulator, exactly. Is that actually the outcome? Is that the outcome you want? I don't think so, right? You'd prefer to have something in which both people were protected in some way. So imagine how difficult it is as the regulator to think about those choices and to think about how it might regulate just that simple example, and now multiply that times a million, right? And that's what happens when new technology shows up. It affects every corner of a regulated market, and understanding the technology itself and understanding its impact and its biases becomes critical for the regulator to understand. So that's why regulation sometimes and often does lag innovation, is because they have to see what the effects of that might be. I'll give one last example that may be helpful, Devon, to the audience is you think about the application of AI when you're thinking about marketing services to a community, and you're a bank and you have a fairness part of your regulation that has to be there. What if your AI is biased in some way because it's looking for a certain income level or it's looking for a certain distance from a bank branch, and it happens to only include a certain type of person, certain class of individuals, and that class of individuals then is different than what the old method might have done, which might have created a fairer opportunity for people of a different variety of religious backgrounds or racial backgrounds or whatever. And so understanding what you're programming into AI and its biases becomes critical. And again, the regulators have to think about how do they make that work in that three-pronged concept of what they're trying to regulate in any given market.
I love that example, Mark, because it's very obvious to us in our daily work that is a risk that has to be taken care of, and we call it algorithmic bias, and it's exactly what you described. And you're absolutely right that if for example, you machine learn an audience for a particular product, and then you begin marketing against that audience, in effect, you're just amplifying whatever past practices the bank has employed and whatever success they've had, and the machines will just learn from that and amplify it. And so the question then becomes are the machines amplifying inherent bias? So that's a spot on example of the amplification effect that machine learning and AI can have on the industry.
Absolutely.
So it suffers from the same bias, and it actually amplifies the bias, which is the risk that we see in our practice. Some interesting questions arise as you begin thinking about this. So, for example, who's responsible if something goes wrong? How do you blame the AI? I mean, that's difficult. Do you blame the programmers? How do you do that? And so there's a sort of open question of who do you blame if something goes wrong? And I think that I think that there is this question, and I think this is something that we take very seriously in our work, is how autonomous, when machines begin to develop autonomous behaviors, how do you make sure that those behaviors fall within the perimeters of regulation? I suspect, Mark, you would suggest that the way to do this from a software design perspective is to just make sure that your product designers are contemplating individual regulations as they apply to the system, and making sure that the system is can only operate within those perimeters.
Yeah, I think that's exactly right. I mean, in the end, as we were saying before, these are just different tools, but they're doing tasks that were done by a previous tool or by a human being. And so you've got existing regulation. I don't think this is a case where new regulation is needed. So there's a fairness standard in banking, right? We don't need a new fairness standard to deal with AI. We just need to make sure AI is transparent enough to show us any bias it may have, or to be able to test it in a way that allows the regulator to feel comfortable there isn't bias there. I think is quite important. I think it's also important to think about, again, from the regulator's eyes, how do they learn? And so engagement with regulators, the FinTech Committee for FINRA, where we spend about 4 times a year talking about new activities. So one of the popular new ones are ICOs, right? These are essentially initial offerings of crypto assets. Many on the call may know ICOs, many may not. It's not important what they are. What's important is they're new, right? And what FINRA is trying to do is to learn, and the FCC is in the room with us, and the state regulators are in the room with us, learning about what the industry and about what providers, maybe startups and others, are doing with ICOs. Well, AI and machine learning is a topic that we've brought to that same committee. How do we make sure there is transparency to the idea? How do we test for bias and so forth? And I think the industry groups for AI, which there's at least 3 that I know of, also can do a good job of publishing white papers and publishing information to regulators to help bring them up to speed on how this new tool is being used. But in the end, it's the same regulations, just applied, with a new tool. Remember.
Yeah, I think you just asked the question I was about to pose, which is commercial innovation. Is always outpacing regulation, and I mean, that was pretty obvious as we looked at the post 2008 financial crisis with Dodd-Frank and the Volcker Rule and the formation of the CFPB. And I think what you just described is sort of how the regulatory system deals with this stuff. Is they learn about it and they apply the same regs. But first they learn, they engage, and then they begin to think about how to make sure that these new technologies and systems can be regulated, and how transparent they can be, how do you test them, and how do you ultimately report out so that they can view them to be within compliance. So I think that was my question. Do you want to add anything?
No, I think that covers it. I mean, there's plenty of mechanisms for the regulators to receive new information. There's plenty of ways that an organization like Micronotes and an industry like AI, the AI industry, can communicate with regulators. And I see good interaction going on in this space specifically. I think in crypto assets, there's still a lot of work to be done because it's kind of coming out of its wild west phase, if we used a different part of the fintech industry, whereas AI is a well-regarded and well-understood capability at these points. And I think some people might not realize just how extensive the use of AI is inside the regulators, particularly in regulating markets. We can talk about that a little bit more. But no, I think we have ways to communicate and ways it's understood. And I think where the regulators want to challenge the industry, where I've seen good interaction there in my history, has been when the regulators say, yes, it may be a new technology that's applied to an old market, and therefore our existing regs will do it. But if there's some other effect that we should be checking or regulating that's here. So an example would be if you deliver something electronically to a consumer, how do you test to make sure that electronic item actually went there? So in other words, what would happen if you sent out 1,000 prospectuses on a mutual fund and it turned out that the spam filters of 1,000 clients prevented them from being delivered, right? Is that a violation?
Yeah.
And how do you deal with that? And the answer is, it is a violation. And so you should have methods to make sure that your new methodology, again, isn't introducing some new problem that otherwise would be there. So it's just thoughtful, common sense usually applies in most cases.
So this is Murphy's Law meeting Moore's Law. So there was an incident in April of 2013 when the AP was hacked and a tweet was posted about the White House exploding and injuries to the president at that time. The reaction was swift and wrong, and this was because of the way the systems were programmed. And so I guess the question, Mark, I have to you is, so both humans and machines struggle to separate fact from fiction. And in fact, this is one of the reasons why the blockchain is an exciting new technology, because it so radically lowers the cost of verification through its distributed ledger. How have you seen regulatory agents handle the verification processes historically, and what might that suggest about regulatory strategy to handle these sorts of bizarre risks in the future?
Well, I think it's, the human condition, right? It doesn't matter that it's a regulator or it's a bank or it's, a fintech provider. The reality is we often don't know what's going to happen. That we all understood that there's risk of hacking, right? That's a well-known risk that's been around for a while. We've all understood that false identities you contribute to that. So you can understand it, but sometimes you can't recognize where the vulnerabilities lie. Imagine if you're on the board of directors of Target, when somebody tells you it was the cleaners of your Target stores that allowed someone to hack into your data, right? That's pretty remarkable that could happen. And no one expected that as those things go. So I think we have to look at this in two ways. One is just to expect the unexpected, right? It's your Andrew Lowe quote. Will go faster and probably be more tragic in the computerized age. But the reality is they're still going to be random, and we need to deal with random situations appropriately, which is to get right on them, understand what happened, do the forensics, communicate very transparently to anybody who's affected, and then learn from that and move on. We will not be able to avoid that. with any tool that comes along that's new. Second thing is that regulators have shown, I think, a real flexibility around recognizing that there's better ways to do things. And I think regulators in particular are quite fascinated by the possibilities of blockchain. As it relates, specifically to things like Know Your Customer, the Patriot Act, implementation across all different organizations, from securities firms to banks, the AML type anti-money laundering regulations as well. So there's just a lot of good things that come from the blockchain utilization, and I think they, like the industry, are waiting for more and more examples that can be commercialized and used either in a consortium form, by a central authority, or by others. You tend to see the verification part be a little more active in European organizations and countries. So I've seen a lot of good work around verification in the small countries of Europe, and also in the application of state pension systems that are interesting. And I'm sure we'll learn a lot here in the U.S. market about how to think about verification, and again, kind of what went right and what went wrong about those implementations as they come into more and more use here in the U.S.
Excellent. Yeah, I think that's. It seems to me that that it is going to be difficult to contemplate everything that can possibly cause this sort of disruption, whether it's the AP being hacked or your cleaners letting people in maybe they shouldn't. But I think that's a sensible approach, and I think that I suspect the regulators are good at really digging into their through their investigative process to the root causes, uncovering both corrective tactical solutions as well as preventative solutions, to try and really
I think Devon, particularly in the area of verification and applications of new technologies, it's been in hacking that we've probably seen the most nefarious use of new technologies in a bad way, right? As opposed to say,
that's right.
the AI and machine learning you're using at Micronotes in a good way, and so that's the greatest concern. And what I've been really encouraged by in my old life as the chairman and CEO of a public company, where we worried about hacking risk and customer private information (PII), is the government's very much a part of understanding what is happening and helping you get over it. The FBI has an amazing set of resources for you to use when you're having a problem. There's a really very easy way to get into a consortium, say when the banks were being attacked, 2 years ago or so, of having the government share information. So I worry less about AI's massive disruption as laid out on this slide, because it's unlikely to happen in the broadest sense of the word, given how the technology is used. But if it were to happen, it's the kind of thing that we've seen before, like your 2013 example, and we can certainly get smart people around it to get it fixed, right? That doesn't worry me.
Yeah, that's an excellent point. That the tremendous investigative resources of the FBI are there to help, which is great. But I agree with you that I think that the kinds of applications that are using AI are certainly not prone to this sort of disruption. So this is, I think this is very consistent with what Mark was just saying, that we certainly don't presuppose that AI will cause problems. AI and machine learning are wonderful tools to do things that humans simply can't do, and so I think the question I have here really is, so if I think about the actual application within our own, with our own business, so we've been exporting campaign content, for compliance review for years, and our roadmap, further automates the compliance review process. We get it. It's boring but important, and but to our customers, and we just have to do it. I guess the question I would have is, what have you seen in the past in terms of how financial institutions prepare themselves to deal with new technology as it relates in a regulatory framework, and what are the costs and benefits of being really well prepared versus maybe not so well prepared, and sort of dealing with it as it comes along?
Well, I think you want to first look at opportunities right to the positive, right? What are the new opportunities for us to be more efficient and more effective at what we do? How can we delight clients, right, in the way we interact with them, and how does AI or machine learning make that happen? And I think the best, existing organizations, incumbents in financial services enter it that way. Can I lower my cost and can I delight my client? And if I can, I want to try that, right? But I might want to try it at a small scale. Let me experiment, in a small way, so that if it fails, the failure is not a difficult one. I will learn something from it, and then I can move on to something maybe, or if it's successful, then I can scale it up to something that's much larger. So I think incumbents that are prepared to experiment and are okay with failing on a small scale, right? Non-fatal failures, I sometimes like to call it, are ones that I've seen as being the healthiest in terms of this new world that we live in, specifically around AI. I think the second thing is that I would certainly highly recommend that in your compliance and regulatory organizations, everybody has a risk committee of one form or another at the bank or credit union or financial services organization. It's a requirement of almost all regulation. And that risk committee typically is doing sign off of new things or sign off of existing processes to make sure they're ready to go and transparent and doing what they say they're going to do. But I'd recommend dedicating some time at those meetings about new technologies and about what you can learn in the way things are changing. So a topic could be about blockchain or crypto assets or AI, that group to study, maybe bring in an outside expert, right, who's willing to just chat with the organization. It doesn't really have to cost you anything. Those people are happy to come talk about those. And that, gets the organization prepared. I do think it's critical, as you were stating in your question, Devon, to be careful about over-investing, though. You don't want it to do 20 experiments at once, right? Unless you're just a massively large organization. You want to do 5 really well and learn from them and move on. But you don't want to over-invest. In the end, banks in particular have the capital, they have the brand, they have the customer trust that startups don't, and that's an enormous advantage. And so, your core business is going to absorb, 90% of your effort, as it should, but do set aside a bit for kind of R&D type spending, and do set aside a bit of your intellectual capital, your people, to think about, how new technologies could be used in your business. And then I think you really want to lift, right, either through your customer hotlines that you may have, call centers that are there, surveys that you're doing, just to see how, either your experiment's going or what new things they're bringing up, that may lead you to a new capability you need to help serve them better.
Yeah, I think that's right on the money, which is continue to look to be more efficient and surprise and delight your customers, and get there through experimentation. I think that's right on the money. Yeah. So I guess one thing, the GDPR, the General Data Protection Regulation, that's now solidly in motion in Europe, is getting a lot of press. Personally, I think it's an important step in bringing data privacy, ownership, and use sort of out in the open. Mark, what's your view on the GDPR, and where do you see it fitting in the sort of U.S. regulatory framework? And is there any historical comparative analog to the GDPR that you can point to help us think about it?
The analog for me is the healthcare, privacy acts that have occurred in the last, say, 5 years or even 10 years in the States, where, as as a consumer, you got a lot of disclosure about, your records. And, in the past, if your child was over 18 and in college and yet you were their provider, in the past, you could get a lot of information about their medical situations, right? And not just to want to pry into your children's lives, but the reality is you're the parent and you're providing their economic well-being and their physical well-being, and understanding those medical issues are there. Today, if your child's over 18, you information except from them, which is sometimes not the easiest thing to do. So I use that as an analog because to me is where we have to be careful about GDPR, is it fits the European model of regulation, which is quite different than the US model of regulation. I think US consumers are quite different than European consumers, right? We like in the US to be given things for free, and we're willing quite happily to trade our data for it, right? I think everyone understands that when they go to search on Google, their search terms are being used to improve Google, right, to make the search process better for you next time, but also to feed their advertising machine. And we're willing to make that trade because it's a wonderfully perfect utility, right? And I could give you hundreds of other examples. So I think we have to be careful about GDPR just sort of being applied here. I don't hear any of that rumbling from friends in the regulatory business or folks in the political system, particularly this particular strain of political system, who are likely to adopt GDPR just straight through here to America. I do think everyone who participates in this kind of business of essentially trading data for capabilities understands the needs for disclosure, the needs for transparency, the need to make sure the consumer gets what's happening. I think it just highlights the importance of making sure that disclosure is being done well and fairly for consumers. So I don't particularly worry about it. I don't think we'll see massive regulation here. I think what we'll see is more disclosure potentially being required, rather than shutting down of activities that American consumers particularly like.
Yeah, I think that's right. And I also think that I heard of one experiment where I think a financial institution in Europe, in the wake of these new regs, had actually opted everyone out in the hopes that they would opt back in, and the phones lit up with complaints because suddenly consumers, weren't felt like their institution didn't know them anymore.
Right. I mean, you don't realize the impact, right?
You don't realize, you just don't realize it until it's not there, how easy data sharing makes your life in many cases. I didn't used to have to fill in this form. It was all pre-filled for me. I wonder how that happened.
Exactly.
So one of the other questions that arose was, so for us, I mean, one of the exciting things about machine learning is its ability to sort of surface primary drivers in a system, and that's done via what's called sort of information gain by attribute analysis, and that just sort of surfaces what's, if you're trying to predict an outcome, what are the major drivers of that outcome. For example, our ML systems discovered that people who take a lot of educational interviews around information security tend to save a lot more money than those who don't. And that doesn't make sense on the surface, but if you think about it a little bit, it actually makes complete sense because the savings nature of risk-aversive people is there. People who are risk-averse save more. So so the machines are able to surface those sorts of things. As we think about regulation, though, and where have you seen statistical analysis really benefit regulation and regulatory strategy, and sort of how do you see regulation changing as we move from sort of a historic statistical model to more of a machine learning AI set of analytic underpinnings? Do you see that changing, or do you see it largely remain the same?
No, I think it'll change. I think just will benefit at the regulatory level and at the group that's being regulated level are things like false positives. We all know that if you're doing AML work, you're getting very high double-digit false positives. It's just the reality of the mechanisms that we use today. But one can easily imagine an application of AI that gets those false positives to much, much lower levels. I've seen some amazing work done by the regulators using AI and machine learning in market monitoring and seeing, trades and related trades that the human eye couldn't see, accounts that are open in 100 different brokerage firms in America, trading that occurs across them that's quite similar. And then you find patterns in that data, as you were saying, that you didn't see before. And so therefore your ability to catch bad actors, in this case, in market manipulation, are really only possible because of AI and machine learning. And those are already in place today, and only going to get better over time and be less expensive as well. So I think that's important. So I see this only as something that ultimately, except for being an optimist, but that these will tend to make everybody more efficient as we go along. I think I love an example that comes from Isaac Asimov, who's of course the famous science fiction writer who has a tie to Boston, having been a BU professor, and he wrote these in 1942 as the laws of robotics. And to my mind, they fit just as well for the laws of AI regulation. And I'll just read them quickly because they're very short.
Yeah.
First of all, it must be subject to the laws that apply to human operators, right? So in other words, your AI has to be subject to the same thing that a human operator would be subject to. Number two, it should disclose it's not human, right? If it's a chatbot that's automatically, doing something with you, you need to know that it's not a human that you're speaking with. It needs to be disclosed. And number three, the system shouldn't retain or disclose confidential information without approval from the source of that information. So he obviously wrote these for a different context, the robotic context, but boy, they're very relevant to the way we think about this tool of AI. So I thought they'd be particularly appropriate for this audience to think about how a science fiction writer can bring together a context for regulation that would be helpful.
That is one heck of a durable set of rules, I would say now, some 60 years later, particularly around confidentiality.
Simple and easy, right? You can understand those things pretty well.
I love that. Well said. So the data is the new oil of the modern economy, and as Mark beautifully illustrated, the benefits are immense of these tools. In understanding complex systems, and of course, data is the fuel for all of that work, certainly the value of data and the value of AI are bringing just enormous benefits to the industry, and increasingly as this conversation progresses, I think it's actually going to be a very exciting time to work with regulators on the regulation of some of these new tools. The last thing on the next slide I'd like to just close with, and then I'd let Mark offer some closing comments. So the one thing I'd just like to close by talking about how we as vendors need to be thinking about how we design products. So the truth of the matter is that AI and machine learning are very complex technologies. If we just look at some of the work that we do, some of the algorithms that we use, these are wildly multi-step complex mathematical functions which sort of rest on top of one another. And I really don't think this notion that everybody needs to be able to to understand these systems at a fundamental level is a good idea. It's just not reasonable. It's I don't understand exactly how my automobile works today, but I can certainly drive it. I understood how it worked 30 years ago, but not anymore. It's too complex, but I don't need to understand it. What I need to understand is what it does, and whether what it does, fits my requirements and for my business. And I think it's just important to remember that, because I don't think we'll ever get to a place where our customers are going to be expected to understand complex mathematics. And I think what that suggests, in closing, what that suggests about us and what we need to be doing, in addition to contemplating the regulatory framework as we design these products for our customers, is we also need to build these systems so they're quite user-friendly for our customers and do not require training in data science to operate. And I think that's crucial, and because if we don't do that, then the consequences are significant, and the consequences are, that if you require a data scientist to run a platform, then what's going to happen is only the people who can afford data scientists will be able to get the benefits of the platform. And many smaller institutions just aren't going to be able to afford data scientists in their normal course of business. So I think it becomes incumbent upon us as designers to not only contemplate the regulatory frameworks in the design, but it also becomes incumbent upon us to make sure that these things can be used by anybody. Otherwise, the value of these solutions will tend to concentrate into the larger institutions, and that, to Mark's earlier point, will make the playing field very uneven indeed. Did you want to add anything in closing, Mark?
Yeah, I think where I'd close is exactly right, Devin. Right, is that at the end of the day, you don't have to know how the car works to ask logical questions of your dealer or your mechanic. And, how much does this cost? Right. What are the benefits? So how does it broadly work? What are the risks that are inherent here? And I think a good process for an organization to use that's evaluating a new technology, whether it's AI or others, is just ask logical questions of the organization they're partnering with in order to make sure they understand the basics of it. So they can turn around to their regulator and say, yep, we've done good diligence. We understand where some of the biases could be in AI specifically, or where some of the downfall could be. So we've done a good evaluation of that. So that's just, again, a good example of common sense. I think the second thing is again, to not fear these new technologies and see them as one that could cause regulators to act in a way that none of us like, right, to be severe or heavy-handed. I don't experience them that way. I think the way to think about it is, how can I experiment with these new technologies in a way that lets me learn as an organization, and if I like what I'm learning, then to scale further from there. And so I just encourage the world to be experimenting with new technologies, because if you don't, that would be the other way that you potentially could have a really difficult business, is that others just got there before you did, and the opportunity just isn't available to you. So you really do need to dedicate some time and resources to these new technologies.
Beautifully said, and I think we'll end there and turn it back to Kevin.
Thank you very much, Devon Kinkead from Micronotes and Mark Casady from Vestigo Ventures. If you'd like a copy of the slides, drop us an email at info@micronotes.com. And of course, to learn more about Micronotes and the company and our products, visit us at www.micronotes.com.